If you want to retire in your 40s or 50s, there's one IRS rule that makes it possible to access your retirement accounts without the 10% early withdrawal penalty. It's called the 72T rule, also known as SEPP, substantially equal periodic payments. It's the most flexible early retirement strategy, but also the most complex and risky if you mess it up. I'm going to explain exactly how the 72T rule works, the 3 calculation methods, the strict requirements, and the massive penalty if you break the rules. The 72T rule is an IRS exception that allows you to take penalty-free withdrawals from your IRA 401k or solo 401k at any age, even in your 40s, as long as you take substantially equal periodic payments based on your life expectancy. The payments must continue for at least 5 years or until you turn 59 and a half, whichever is longer. So if you start at 52, you must continue until 59 and a half. That's 7.5 years. If you start at 45, you'd continue until 59 and a half. That's 14.5 years. You calculate a payment amount using an IRS-approved method, then take that same amount every single year. You cannot skip a year, take extra, or stop early. If you break the rules, the IRS retroactively applies the 10% penalty to every withdrawal you've ever taken, plus interest. Once you start, you're locked in. Now, the 3 IRS-approved calculation methods. Method 1. Required Minimum Distribution, or RMD. This divides your account balance by your life expectancy each year. The payment recalculates annually. This gives you the smallest annual payment, but it's the most conservative. If your balance drops, your payment drops. Example: you're 50 with $500,000 in your IRA. Life expectancy is 34.2 years. First-year payment is $500,000 divided by 34.2, which is about $14,620. Method 2. Fixed amortization. This treats your account like a mortgage. You calculate a fixed annual payment based on life expectancy and an IRS interest rate. The payment stays the same every year, regardless of account balance changes. This gives you a higher payment than RMD, but it's riskier if the market crashes. Example: same $500,000 balance, age 50, 5% rate. Your fixed payment is about $32,000. That's more than double the RMD method. Method 3. Fixed annuitization. Similar to fixed amortization but uses an annuity factor. It typically gives you the highest payment of the 3 methods, around $33,000 to $35,000 per year. You choose one method when you start and you're locked in. There is one exception. The IRS allows a one-time switch from fixed amortization or annuitization to the RMD method. This can be useful if the market crashes, but you cannot switch back. Now the requirements. First, payments must be taken at least annually. Second, once you start, you cannot make any additional contributions to that account. Third, you cannot take any extra distributions beyond your scheduled payment. Fourth, you cannot stop the payments early. Fifth, the penalties for breaking the rules are severe. The IRS applies the 10% penalty to every distribution you've ever taken under the plan, going back to year 1, plus interest compounded annually. Example: you started a 72T plan at 48. You took $30,000 per year for 7 years. That's $210,000 total. At 55, you accidentally take an extra $10,000. The IRS hits you with a 10% penalty on the entire $210,000. That's $21,000 in penalties, plus interest. Total penalty could be $25,000 or more. You absolutely must work with a CPA or financial planner. One mistake can cost you tens of thousands. The IRS updated life expectancy tables in 2022 with IRS Notice 2022-6. These reflect longer life expectancies, meaning smaller annual payments under the RMD method. You can use your own life expectancy or joint life expectancy with a beneficiary. Once you reach 59 and a half and meet the 5-year minimum, the plan terminates automatically. You can then take as much or as little as you want without penalties. Here's what to consider before starting. First, do you have enough to sustain payments without running out? If you're 45 and need $40,000 per year with only $500,000, you'll deplete that account in about 12 years. Second, can you commit to the payment schedule for the full duration? If you get a big contract and don't need the money, too bad. Payments must continue. Third, which method makes sense? RMD is conservative. Payments adjust with balance. Fixed methods give higher payments but lock you in. Fourth, do you have other income sources? Most early retirees combine 72T with taxable brokerage accounts, Roth IRA contributions, or rental income. The 72T plan is one piece, not the entire solution. Real-world example, you're 52 with $800,000 in your solo 401k. Life expectancy is 32.3 years. Using RMD, your first-year payment is about $24,770. Using fixed amortization at 5%, it's around $50,000 per year. You also have $200,000 in a taxable brokerage account. Your strategy: take $25,000 per year from the 72T plan using RMD. Take $25,000 from your brokerage account. That gives you $50,000 in annual income. Here's what you need to do. First, research the 72T rule in detail. Read IRS Notice 2022-6. Second, model your cash flow. What happens if the market drops 30%? Third, consult a CPA or financial planner who specializes in 72T plans. This is not a DIY strategy. Fourth, consider alternatives like Roth IRA contributions or taxable brokerage accounts. The 72T rule is the most powerful tool for early retirement, but it's complex and punishing if you break the rules. It works if you plan carefully and work with professionals. If this helped, subscribe for more early retirement strategies. Drop a comment if you're considering a 72T plan. See you in the next one.